And greetings and good day. Welcome to GSGM's webinar discussion with regard to the on-the-ground situation in China relative to trade issues. My name is Paul Mackler. I'm president of GSGM. I am joined by Mark Mackler, our vice president. And Mark, thank you for joining with us. We've been on the ground in Asia for over 32 years, with very few companies can really provide that type of experience and background as we can at GSGM. This is well recognized by our clients and our partners. What a difference a day makes. One day our supply chains are functioning with reasonably competitive costs. Within the next short period of time, you're faced with increased costs for tariffs from 10 to 25% with no end in sight. Risk management teams are ramping up to consider potential options to remain competitive, whether it be from China and or from alternative sources of supply. We are very pleased to welcome our participants from a broad range of industry sectors. All are facing multiple challenges to increase sales, reduce costs, and provide your shareholders with a strong return on investment. Action must be taken to assure your expectations. GSGM has been located in Asia for over 30 years. We're an American-owned firm. We offer turnkey assistance for a combination of services, including best cost country services, sales and marketing of U.S. and European products and services into Asia. We provide competitive intelligence and primary market research. We provide transactional due diligence relative to Asian activities of targeted companies. We work with a who's who roster of industrial, private equity, and turnaround clients. We have offices in the United States, China, and Korea, and provide 24-hour project support. We have a highly technical firm with sourcing, engineering, and sales and marketing professionals. GSGM has assessed over 1,500 plants in Asia. We're considered a strategic partner by our clients on the ground in Asia every day, working on their behalf. Over 60% of our clients have IPOs or plants in China, and they seek our advice, counsel, and assistance to help them implement most successful programs. As part of our webinar today, we will be discussing the tariff situation in Asia and the United States, renegotiating current supply agreements due to currency changes, options going forward to include change in country of origin, issues being faced by U.S. companies with Chinese facilities, assessments of competitor supply bases and import swings, and exit strategies and areas to consider if departing the China market. We welcome your questions and will respond to them shortly after the webinar. If you plan to leave, consider the following: enforcement of the NDAs you have in place, tooling and other capital equipment removal, and the processes to accomplish same, negotiation of exit strategies that don't make a competitor out of your current supplier. If eliminating staff, understanding the laws and regulations with regard to severance and social benefits, to name a few. I'm sure many of you are considering, what can I do now? Right now, you can go ahead and start renegotiating your supply agreements. Currency swings have helped offset a reasonable amount of the tariffs, but now is the time to secure pricing concessions. There is also open now new open capacity from high-end quality suppliers across China for the first time in a while. Let GSGM identify, profile, audit, and benchmark them for you. For GSGM's experience with over 1,500 plants in Asia, take another careful look at cost reductions through the design or redesign of your products and vertically integrate those products to improve total cost of ownership. Carefully study the options of establishing an operation in China or Mexico that can do finish manufacturing to allow for a country of origin change. This is a chess match. Both the U.S. and China have a broad range of options, including economic and geopolitical options. China has a strategic patience and can wait out the administration. Only 9% of China's GDP is from exports. There are no checkmate options for either country. Businesses must prepare for a prolonged trade war. Proposals are only proposals. They must be implemented, verified. Companies must make their strategic moves based on real on-the-ground G2 and consider the impact to their companies if they do not act. We are here to help you. What brought this on? The U.S. goods deficit with China was $375 billion in 2017. This deficit grew in 2018. The disparity in the fourth quarter of 2018 continued to grow in spite of the tariffs. The new tariffs should start to kick in during the first quarter of 2019. Don't expect the problems or a major portion of the deficit to go away in 2019. As Commerce Secretary Wilbur Ross noted on January 24th, we are miles and miles from a trade deal. Again, as what Secretary Ross said, we're miles and miles from a trade deal, and China's Ministry of Commerce warned that the dispute may even lead to the largest trade war in economic history to date. Thus, we have a long way to go. These are examples of tariff timelines and key dates, starting in April of 2017. By September 24, 2018, the U.S. had implemented tariffs on $250 billion worth of goods. Initial rates ranged from 10% to 25%, with the threat that the 10% tariffs could go to 25% by January 1st, 2019. Subsequently, a 90-day cooling off agreement was reached, noting that if agreement were not reached, the 10% tariffs could rise to 25%. It is GSGM's view that it is a real stretch, again, that any deal could be achieved by the deadline. It's more likely that a continuation of the current tariffs in place today and a further extension will occur. In the meantime, China has moved to diversify their markets, diversify their supply bases, weaken their currency to make their goods lower in price when purchased in U.S. dollars, change their VAT tax policy, add stimulus into the economy, increase many tariffs related dramatically on imports of American products into China, use their vast foreign exchange reserves to strengthen their supply of critical materials, goods and services, and strategically positioning themselves globally. The geopolitical events such as North Korea, Taiwan, and the Taiwan Straits, shift in foreign exchange investment policies in the U.S. market could all become game changers, both for the U.S. and China, as well as the rest of the world as a whole. We encourage the renegotiation of the current supply agreements wherever possible, as soon as possible, in order to help reduce a portion of the increased costs of tariffs. The RMB currency has been substantially weakened, thus reducing the cost of Chinese goods when paid for in U.S. dollars. The VAT tax policy was modified to reduce the rate of VAT taxes to be paid and recovered on exports. Payment conditions should be renegotiated as soon as possible to improve your cash flow. Financials should be obtained on the main suppliers and your customers. Transfer pricing should be considered carefully when selling products from a division in China to your USA customers. Review changes in country of origin very carefully again. Review potentially changes in your supply base to low-cost countries. Review onshoring strategies to the USA. Review onshoring to Canada and Mexico to change the country of origin wherever possible. However, I should note you must meet Section 301 requirements with regard to change of country of origin. The weakening of currency rates in Asia and in China have reduced the cost of goods and services when purchased in U.S. dollars. It has also increased the profits for those Chinese suppliers when supplying goods paid for in U.S. dollars, if a portion of that, if you will, profit gained has not been passed along. Thus, negotiations to share the benefit of the weakening of the currency should take place with their suppliers who are paid in U.S. dollars as soon as possible. As you can see from the currency low to the current currency rate, there's been a change of about 8.3% in this year. This has, in most cases, been to the benefit of the Chinese supplier if paid in U.S. dollars because they retain the margin benefit. You should try to negotiate to at least receive benefit from a portion of this change in currency. As you can see, the currency strategy has changed from 2018 until now with our change in administration in the States and the implementation of tariffs. The currency rates may have been weakened further, except for the Chinese desire that the RMB currency become a major global settlement currency. Thus, the weakening or volatility in the currency is counter to the desired expansion of the RMB as a settlement currency. What's in your competitor's container? Have you ever wondered where your competitor is buying their products? GSGM's in a position where we could, for example, take your 5 or 10 major competitors and provide an output report on where your competitors are buying their products both within China, within Asia, and globally. We can also provide a trend analysis on those particular suppliers and or your competitors' overall supply base. GSGM is also in a unique position to secure financials on about 90% of the companies in China. We also can provide quality audits for the identified competitors and or suppliers, as well as work closely with your strategic planning team to help develop a most successful program. You have worked hard and you've spent considerable resources to develop it. Now protect it. Many USA buyers are sprinting to change their country of origin from China to either Canada or Mexico. Many in their minds think the main criteria is only the percentage or content element, which it is not. Products also have to meet the substantial transformation standards to help change the country of origin to Canada or Mexico before importing those products from either Canada or Mexico into the USA. If one is not in compliance, they can be subject to duties under 301 rather than current NAFTA agreements in place. Furthermore, the importer of record is at risk for duties and penalties. No one can arbitrarily change the STS code or country of origin without complying with all the rules and regulations in place. There is a process, however, which can be followed whereby one can receive a formal customs ruling either on the HTS code itself and or the country of origin. Is China still viable? In most cases, yes, if China is both a supplier and China represents a large market opportunity for the products you produce in China. Thus, you have markets both in the U.S. and China. There is no one right answer. If you only source from China, one should conduct a very detailed review both of the short and long-range implications of the relationships between U.S. and China. the subsequent economic and geopolitical events, the total cost of ownership, supply chain disruptions, the ability of other countries to supply the level of quality at competitive prices. After all, the two countries represent the two largest economies in the world. As we consider the viability in China, obviously you have to consider very carefully whether you're just sourcing specifically from China, or if you, in effect, have markets in China where your sources of supply will supply both your operations in China for China as well as your operations globally. Can you justify duplicating tooling costs and CapEx in other countries to reduce the cost? And what is the return on investment for same? Can you vertically integrate the products, re-engineer the products to add value in China, and with the margin with efficiencies and lower labor costs in country, even though the total cost of the item is increased, however, the margin after the impact of tariffs might also be reduced. And there's a Go West strategy. As you know, in China, typically labor costs, sometimes energy costs, and other costs are lower in the more western provinces, and therefore you could consider that also as a strategy. As noted in conclusion, there's no one right answer to this historically challenging period. One must consider renegotiating your existing China supply agreements with regard to currency swings, lower VAT refund for exports, and payment in shorter time frames. Request supplier financials regularly and look at supplier inventories. World-class suppliers now have capacity that haven't had capacity for a while. Terms, work on payment terms and conditions to improve your cash flow for your organization. The Chinese government is stimulating the economy, providing a more stable environment. In 2019, the global GDP is estimated at 2.9%. The U.S. economy is estimated at about 2.3%. And UBS recently forecasted China's GDP at 6.1%. China's exports only account for 9% of their total GDP, and thus they are in a unique position to be able to grow their country based on their internal restructuring and urbanization. However, they must consider carefully that their debt is growing faster than their GDP growth rate, and this is a concern, obviously, to the World Bank and others. Global recessions are expected somewhere in either late 2019 or 2020. Recently, Goldman had indicated that they anticipated that there might be a 15% chance of a recession in 2019, but actually a 50% chance potentially in 2020 or 2021. Also carefully consider at what point should you consider moving out of China should this trade war continue and should there not be any profits remaining in your products. And also consider various other facets which GSGM would be very pleased to discuss with you and the potential next steps for same. Mark and I would like to thank you and your team for joining with us today. Your companies are leaders in the markets you serve. We at GSGM welcome the opportunity to continue our discussion and help maximize your potential opportunities and successes. You can reach out to Mark Mackler, our Vice President in the USA, at 610-996-0280 or mark@gsgm.biz. I can also be reached in Asia at 86-135-1100-8801, paul@gsgm.biz. biz. There's an old saying, the only limitations are those of vision. Thus, there are no limitations. Let us know when we can set up a follow-up conference call together so we can help you with your strategic decisions in 2019 and 2020, as well as the implementation of these decisions. Thank you very much for joining with us, and I hope you'll have a great year in 2019.